Silver I call is the drama queen. There's going to be a shortage of silver for solar panels, for any type of vehicle, phones, anything electronics. All your military is all silver. Deliveries is going to be around 20 million ounces. Yeah, we didn't have a deficit for the fabricators. The deficit is all investors. You cannot have shortages of silver. The reason why, number one, the economy, right? You can't shut down GM's plant. You can't shut down iPhone's plants. They got to have silver, right? So the other one is military applications. In other words, they can't just take inventory away from retail easily. It's because the biggest buyers of silver is India and China. U.S. citizens, they can't buy silver anymore, but we can. They basically make a phone call to JP Morgan and say, hey, we want to buy your silver. And so it'll probably be the U.S. government, and the U.S. government will buy their silver, and then they'll basically say, hey, silver's for sale, who wants it? And then Trump will use it as leverage over China, and they'll say, look, we got all this silver. We'll sell it to you, but we want, in exchange, quid pro quo. I always say that, that gold is kind of, big brother, and silver's little sis. And gold is kind of the masculine metal. In astrology, gold is Leo, and it's the sun. And so that's the masculine side. And silver is the feminine side. It's Cancer, and it's the moon. And so you can't understand silver. Silver's impossible to understand. Silver I call is the drama queen. But it's always it's always about gold. The story is always about gold. Gold's the big leader. Gold is the king. Gold's on the throne. Silver's more the queen, right? You never know what the queen's going to kind of do. And so it's all about the S&P 500. Which is, we watch that number one, that chart's most important. That's what's driving gold. It's going to drive gold up, it's going to drive gold down. And then they'll decouple. But it's all about, right now, it's all about the S&P and gold. Silver is over here on the side. It's the side story, if you will. It's the drama queen.
The hidden message here isn't astrology. It's correlation risk hiding in plain sight. What he's really saying is gold is still trading like a risk asset, tethered to the S&P 500, which historically happens late cycle when liquidity dominates fundamentals, something Don Durrett has warned about during previous equity peaks. Data backs this up. Over the last decade, gold's rolling 12-month correlation with the S&P has repeatedly spiked above 0.6 during liquidity-driven rallies. Silver's volatility isn't randomness, it's leverage on gold once that correlation breaks. Investors ignoring this linkage risk misreading silver's swings as chaos instead of structure. When equity leadership fractures, that drama queen becomes the signal. What he says next explains why that decoupling rarely happens quietly, as Don Durrett has emphasized.
But as I wrote, the first edition of my book, I wrote in there that there's going to be a shortage of silver. There's going to be a shortage because there's just not enough silver for both fabricators, which need about 70%, which need about 700 million ounces a year. It's a lot of silver that's necessary for solar panels, for any type of vehicle, phones, anything electronic. So silver's, it's got massive industrial needs, if you will. All your military is all silver. And so, then once the investors say, well, we want some too, at that point, there's not enough. And so silver, once it got above $35 and below 30, and nobody cared about it. There's no interest, just the small little retail crowd, the silver bugs. There's no interest really. Once you got above 35, all of a sudden it became a monetary metal, and now the investors are here to buy it. At that point, silver ripped from 30. It was at 35 in August, early August, and off to the races. It went to 40, 50, 60, 70. It's just been going. So
the shortage story sounds obvious now, but Wall Street ignored it until price forced their hand. Industrial demand already absorbs roughly 70% of annual silver supply, a structural fact Don Durrett has highlighted for years, while analysts kept modeling surplus scenarios. What changed wasn't fabrication demand. It was investor psychology, once $35 flipped silver from industrial metal to monetary asset. That's when price discovery stops being smooth and starts becoming reflexive. The uncomfortable truth is institutions don't lead these moves. They chase them once price validates the narrative. Retail gets blamed for volatility, but supply math created it. Next comes the part most investors underestimate, and Don Durrett consistently warns about it.
We got September, October, November, December, 4 months, 4.5 months. It's went from 35 to 90. It's up 25% in 2 weeks. It ended the year at 70. It's at 90. Up 25% in 2 weeks. And the reason why is because there's not enough of it. So we have this big problem with inventory levels, and but silver is going to be uber volatile. You're not going to get a free ride on silver because that's not how it works. Silver is going to be volatile, and I'm going to tell you why it's going to be volatile. There's lots of reasons for silver to get whacked, if you will. The first reason is, and I don't know when it's going to happen this year, but I expect it at some point, is the S&P is going to correct. And the S&P corrects, it'll pull down gold and it'll pull down silver. And silver, back in October, gold corrected 12%. Silver corrected 18%, so 50% more. So that's kind of what you can expect. Silver's going to, and this time, because silver's outran gold, it will probably correct more than 50% of whatever gold does.
This is where excitement turns into risk management, and most investors fail. A 25% move in 2 weeks isn't bullish confirmation. It's stress on positioning, something Don Durrett frequently flags during late-stage metals rallies. Historically, silver amplifies gold's drawdowns by 1.5x to 2x during equity corrections. Exactly what we saw in October, when silver fell 18% versus gold's 12%. That volatility doesn't invalidate the thesis, but it punishes poor sizing and leverage. Silver rewards patience, not bravado. If you can't tolerate sharp retracements, you're not positioned, you're exposed. What follows explains why the next pullback may actually strengthen the long-term case, as Don Durrett notes.
But the good news is that gold is so well positioned this year that I don't think we have to worry about more than a 12% correction. I mean, 15% outlier at worst case, but that would be very short-lived. But the more likely scenario is gold only goes down like 8 to 10 this year. And when it does, everybody's going to know this is a buying opportunity. Gold is the new buy the dip asset. And it's going to become very obvious this year, especially how fast this thing bounces. And so if they can't hold gold down, then they can't hold silver down. But so that's the first thing that's going to create volatility in silver. The second thing that's going to create volatility is the shortage. I think the shortage could come as early as March. I've been having these conversations with Grok, and we argue. Grok's more pessimistic than me. Grok thinks that the silver inventory problem is going to happen in Q1. I think it's going to happen in Q2, so we're kind of fighting over it. But I'm hoping Grok's right. Now, the reason why Grok thinks that the problem is going to happen in Q1 is that the deliveries are unsustainable.
Calling gold a buy-the-dip asset signals a regime shift most portfolios aren't built for. If corrections are capped near 8 to 10%, it suggests structural demand. Central banks, sovereign buyers, and reserve diversification. Is absorbing supply a point Don Durrett has repeatedly emphasized? The real catalyst isn't price pullbacks, it's delivery stress. When physical settlement overwhelms paper markets, volatility accelerates upward, not downward. Whether the shortage hits in Q1 or Q2 matters less than the fact that inventories can't sustain current draw rates. Markets don't wait for consensus, they react to constraints. Next, he explains why delivery mechanics, not headlines, may define silver's next phase, something Don Durrett has long cautioned investors about.
So if you look at the deliveries, historically the deliveries are like, 15 million ounces, 10 or 15, and at most, even less than that. But at most, you never see it any higher than that. Now we're kind of doubling that and tripling that. And last year, the deliveries last year was, I believe, 90,000 contracts. That's 450 million ounces. That's more silver than is currently, on the COMEX. And for March, so they have what they call these major delivery months. So, and the first really major month of the year is in March. No, normally January and February are not big months, but this is an unusual January. Deliveries is going to be around 20 million ounces. So we get 20 million in January. We're looking at 50 million plus in March. That's a lot of silver delivery. And so everybody knows that it's coming. And so last year we had 200 million, approximately 200 million ounces of a deficit. So in other words, investors, it was all investors, right? Supply is about 800 million ounces. That's plenty for fabricators. That's plenty. So we didn't have a deficit for the fabricators. The deficit is all investors. It's all investors, right?
This isn't a delivery surge. It's a structural stress test the paper market wasn't built to pass. As Don Durrett has pointed out, when annual silver deliveries suddenly approach half of total exchange inventory, price discovery stops being theoretical and starts becoming physical. Historically, COMEX deliveries average under 15 million ounces per month. So talking about 50 million in March is not normalization. It's escalation. The key detail Wall Street avoids is that fabrication demand wasn't the problem. Investor demand drained inventories instead. That shifts power away from futures pricing toward whoever controls remaining supply. What comes next explains why this pressure doesn't resolve quietly, as Don Durrett consistently warns.
We had 200 million deficit last year. So the supply is around 800 million production, 200 million recycling, and then deficit of 200 million ounces, which came all out of inventory. So we had, the last 3 years, I think that the deficit 600 million ounces. Last 4 years, 600 million ounces. This year, 2026, it's estimated that the deficit is going to be 300. So it's going to be somewhere between 250 and 300 million ounces of silver that has to come from above ground inventories. There's not very much left after 600 million ounces over the last 4 years. So this is the reason why Grok is so pessimistic about Q4. And so this is where we get volatile. Government is going to have to do something to create inventory because you cannot have shortages of silver. And the reason why is, number one, the economy, right? You can't shut down GM's plant. You can't shut down iPhone's plants, right? You can't shut those plants down. They got to have silver, right? So they're going to have to find, but the other one is military applications, right? Military, you can't shut down, production of military. So there's these massive incentives for governments to figure a way out to create inventory. And so that is coming. And when it happens, but the one thing about that is it's dicey. It's not cut and dried.
This is where supply math collides with political reality, not market theory. Don Durrett has repeatedly noted that a 300 million ounce deficit isn't cyclical. It's systemic, especially after inventories already lost roughly 600 million ounces since 2022. Governments don't tolerate shortages in inputs tied to autos, electronics, and defense, regardless of price signals. That means intervention risk rises, just as investors assume free markets will resolve it. For portfolios, this introduces headline volatility and policy shocks, even if the long-term thesis stays intact. Silver becomes strategic, not speculative. Next, he explains why policymakers have fewer levers than investors assume, something Don Durrett emphasizes often.
In other words, they can't just take inventory away from retail easily. And the reason why is because the biggest buyers of silver is India and China. And so they try to cut off retail purchases in the West. They're like, China and India goes, thank you very much. We'll take it. In other words, they're not going to stop. India is a perfect example. they're not going to say to their consumers, we're not going to let you guys buy any more silver. That's not happening. It's part of their culture. Yep. It's part of their culture. They're going to allow their citizens to buy silver. So, hey, that's great. U.S. citizens, they can't buy silver anymore. But we can. That's beautiful. Thank you very much. So it's kind of a, chop off your nose to spite your face situation. So it's going to be really difficult. So cutting off the retail trade. The other one, which I think is the low-hanging fruit, is to basically force the ETFs to basically, close down and then dump all their silver on the market. That's the low-hanging fruit.
This exposes a geopolitical blind spot most Western analysts refuse to confront. As Don Durrett has highlighted, silver isn't just an asset in Asia. It's cultural savings, making retail bans politically impossible in India and China, which together account for over 50% of global physical demand. Cutting Western retail access doesn't reduce demand, it reroutes it east. That's why ETF liquidation becomes tempting for policymakers. It's centralized, visible, and legally easier. But forced selling signals desperation, not control, and markets usually smell that early. What follows shows why this easy lever may carry consequences Don Durrett consistently cautions against.
The other one is JP Morgan has a big inventory. So they basically tell JP Morgan, hey, look, you don't need that asset. You're just making money. Sell that to us. So I think that is the lowest hanging fruit because that literally has no ramifications. That doesn't hurt anyone. Whereas if they shut down an ETF, that creates a lot of pain because that's basically the government taking away someone's assets, infringing on your rights. But at JP Morgan's inventory, that one's low-hanging. That one's the lowest of low-hanging fruit. So I think that one goes first. They basically make a phone call to JP Morgan and say, hey, we want to buy your silver. And so it'll probably be the U.S. government, and the U.S. government will buy their silver, and then they'll basically say, hey, silver's for sale. Who wants it? Right? Mm-hmm. And then Trump will use it as leverage over China, and they'll say, look, we got all this silver. We'll sell it to you, but we want in exchange quid pro quo.
This is where markets quietly give way to power, not price. Don Durrett has noted that concentrated inventories act like pressure valves during shortages, and JP Morgan's silver hoard fits that profile perfectly. A government-to-bank transaction avoids market chaos, preserves optics, and keeps futures plumbing intact, at least temporarily. But once strategic stockpiles enter diplomatic bargaining, silver stops being a commodity and starts behaving like oil in the 1970s. For investors, that means pricing won't follow models. It will follow policy. Next comes the part Don Durrett warns separates patient holders from reactive traders.
Gold and silver prices have to go up. If they just stay flat, inflation will slowly hit the cost. The cost will go up. If gold and silver prices stay flat, you don't make any money. You might lose money. So you're speculating on higher gold and silver prices. That's the only reason we own these things. And I believe we're getting higher gold and silver prices. So any stock anybody that's reporting earnings, all we're really looking for is the story changed. Mm-hmm. We don't, okay, they had a good quarter, but did the story change? Did their costs go up? Did their costs go down? What's the trend of their cost? But we're not thinking so much about, oh, fabulous quarter, oh, great, That's how you think in terms of, an investment, Microsoft, Google, quarter to quarter. They do quarter to quarter. In mining stocks, we don't do quarter to quarter because gold and silver are too volatile. What's the underpinning of gold and silver? I would say 75% of the value of a company is gold and silver. And the underpinning of gold and silver is kind of the overall macro data.
Flat prices quietly destroy mining economics long before headlines admit anything is wrong. As Don Durrett points out, inflation doesn't pause just because metals prices stall, and that's why flat gold or silver is effectively a losing trade for producers. Roughly 75% of a miner's valuation rides on the metal price itself, not management brilliance or quarterly execution. That's why cost trends and macro forces matter more than one clean earnings print. Investors focused on quarters miss the real driver, sustained macro pressure pushing metals higher. Next, Don Durrett explains why price direction, not earnings noise, decides who actually wins.
What drives gold and silver, right? If gold and silver prices right now were under $3,000, I might not even be talking to you. Gold and silver are the whole price of gold and silver is the key to it all. That's what
we may not have any viewers at that.
Yeah, he might not. Nobody's even interested, right? So this is all about gold and silver, and it's not about quarter to quarter. It's more about year to year. I always say, focus on the prize. Like, if you look at the fundamentals of gold and silver, they basically, in my opinion, scream that gold's going to trend upward. Gold's not. The trend is up, not down. And that's not, if you look at the macro that's kind of pushing gold, there really isn't any macro that says gold's going lower, right? You don't see it. So the chances are pretty good, probability wise, that gold's going to go higher, silver's going to follow, and the multiples are going to expand as the balance sheets improve. And so this is kind of a best case scenario for investors. So I've been waiting for this for decades. I thought we were going to get it in 2011, 2012, but it didn't happen.
Interest only returns once prices confirm the trend, not before. As Don Durrett has noted, investor attention follows price, not fundamentals, which is why sub $3,000 gold would mute this entire conversation. Macro signals, debt expansion, real rate pressure, and currency dilution still point upward, not down. That raises the probability that gold leads and silver follows, expanding mining multiples as balance sheets heal. For long-term investors, this isn't excitement. It's patience, finally aligning with macro reality. Next, Don Durrett explains why this cycle looks structurally different from the 2011 false start.
It would have happened if the economy wouldn't have came back up. But the Fed basically, we didn't have inflation back then, so the Fed could take rates to zero, print at will, and basically get the economy back on its feet again. This time, it's going to be a lot harder for the Fed. So there's a very good possibility that this bull market kind of has legs here and could go all the way to 28, 29. In tandem with the stock market, in tandem with gold being higher, and then in tandem with, people starting to recognize that gold's probably, you're not going to correct. But right now, Wall Street, so I'm expecting really solid earnings. So the average gold price in the last quarter was $4,150. So $4,150, that's about $1,800 margins. Those are pretty darn solid. That's average. So some companies are going to have $2,000 margins plus, which is pretty amazing when you think 2 years ago gold price was $2,000. Now we have $2,000 margins. So I think the earnings season is going to be really good, but you don't want to own these mining stocks. This is probably the better takeaway from here about earnings season. Okay, the earnings season is going to be very, very strong, and these miners are probably going to tick up a little bit.
The Fed's old playbook worked once because inflation wasn't watching. As Don Durrett has emphasized, zero rates and unlimited printing aren't painless options when gold margins already exceed $1,800 an ounce. With average gold prices near $4,150 last quarter, miners are printing profits even before Wall Street fully believes the trend. Yet institutions still hesitate, treating earnings as temporary rather than structural. That disconnect creates opportunity and risk for investors who mistake margin strength for cycle completion. Next, Don Durrett explains why strong earnings don't automatically mean safe ownership here.
But people are ingrained with this idea that you make money quarterly and annually, and you're always trying to make money. You're always trying, your portfolio always trying to go up, 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 up. That's not what mining stocks are about. Mining stocks are cyclical, speculative bets. You shouldn't even be playing with this stuff. You should only be invested in gold and silver mining stocks if you're willing to lose money, not expecting to make money, willing to lose money, especially be willing to be underwater. Most stocks, I would say 90% of the stocks I've ever bought have been underwater at one time or another because of the volatility, the nature of this stuff. These are not strong companies. These are companies that are totally dependent on the price of gold and silver, which goes up and down. And so you shouldn't even really be that concerned about quarterly earnings. The only thing that we're trying to do, we just don't want a company to, so you buy a company for its story, and you buy a company with an expectation of the future, and it shouldn't be 12 months. You should never buy a gold mining stock. I'm going to make money in the next 12 months. That's just reckless gambling, reckless speculating. You need to think in terms of, in gold mining stocks, more 24, 36, 48, more long-term investing. And you know why you bought it. For instance, so if you own a mining stock, this quarter isn't really not nearly as important as what happens over the future.
Mining stocks punish impatience faster than almost any asset class. As Don Durrett often stresses, these are not compounding machines but leveraged bets on metal prices, and 90% of positions will test conviction by going underwater. Quarterly thinking turns volatility into emotional mistakes, not returns. The real risk isn't drawdowns, it's entering with the wrong time horizon and calling speculation investing. For portfolios, position sizing and timeline matter more than earnings surprises.